Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is July 24th, 2025, and today on our call we have Stathonikos from NexLiving Communities. NexLiving trades on the TSX Venture Exchange under the symbol NXLV. The company is currently trading at $1.78 with about 33 million shares outstanding, or about a $58 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, Trevor, thanks a lot. Stavro, great to see you. I think we saw you about a month and a half or so ago in Vancouver. So we got an opportunity to understand what NexLiving is all about, but you're here to tell our audience what you guys are all about. So welcome. I'm just going to turn it over to you. You get a presentation ready to go, so I'll let you get at it.
Perfect. Okay. Well, look, first of all, thanks for everyone spending the time to hear what we have to say, and especially Paul and Trevor for hosting me. Yeah, I really enjoyed our conversation a month ago, right? And so it's good to have this follow up. So I'll start. Let me just give a little bit of introduction. We're a not a very well known company. So NexLiving, we're a multifamily apartment owner and operator. The company's profitable. We pay a dividend. We're buying back shares, so we're free cash flowing. Our strategy is a little different than what you might be used to with some of the other multifamily names in the public in Canada. We invest in secondary markets that are cherry picked, that are seeing the highest growth in Canada. Our buildings stand out. They're newer, vintage buildings, large apartments, well appointed, and we're targeting primarily the downsizer market. If you kind of look at our portfolio, we've been the highest growth on pretty much every metric, organic or acquisitive, Canadian company in our space over the past several years, but still quite small. I sometimes joke where we've been racing to the starting line. But before we talk about what, I want to talk a little bit about why. All right, so I think it'll provide some context on our purpose and why we're doing what we're doing. So I mentioned secondary markets, and I'm sitting here in Toronto, and Paul and Trevor are sitting in Vancouver. So I thought I'd pick on Toronto and Vancouver, and against sort of pit them against our markets. We set out to build a company that's a leader in secondary markets. There are a number of cities in Canada. I don't know where everyone on the phone is, but there are a number of cities in Canada where they're very important cities in Canada, and they're seeing growth. But the large capital pools don't traditionally invest there. But they're actually seeing the same population growth and job growth that the core cities are seeing. So we go where the fundamentals are strong, but competition is low, and that inherently is the setup that we think drives better returns. We just had an election in Canada a few months ago, and we heard a lot about affordability crisis and crime rising, and that's true. But really, that's only true in the larger cities. We had a social contract. I'm an immigrant to Canada. We had a social contract in Canada that if you came here, no matter what was going on in your home country, and you worked hard, you could, buy a house and create a life. And I think that's changed, but it hasn't changed in the majority of Canada. It's really only changed in the core cities. So, everyone's seen these metrics. I've kind of put them here on a slide, so just to juxtapose and see, just to compare what's going on. But I think the one that stands out the most to me is that if you look at the rents in Toronto and Vancouver on average relative to the rents that we have, and if to understand, we're comparing 50, 60-year-old buildings to the majority of our buildings have been built in the last 10 years, so newer, modern, energy efficient, and well amenitized buildings. The rent is half, and that actually doesn't even tell the whole story. The apartment size is double. So on a price per square foot or a price per pound, you're paying a quarter of what you're paying in the larger city. And therein lies apartment renters are very sensitive to price. And we think our product offers incredible value. And that shows up in our vacancy, it shows up in our rent growth, and it shows up in all the metrics. And then you got to go down a list. And some of these traditional metrics that you might think were true in Toronto and weren't true in the rest of the country, like the unemployment rate, it's better. Or the population growth, it's better. And then you look at the rents have kept up. The growth that we've seen in these large cities relative to the cities we operate have been, they basically walked in lockstep. But when you kind of look at it from a landlord's perspective on this slide, you'll see that on a multiple basis or a cap rate basis, we've been entering our initial day one going in cap rate at a 20%, 15, 20% discount to the core market, seeing the same rent growth. But our biggest cost, which is the cost of debt, these are high, where it's a high capital consuming business, is the same. Right. So we think that that's a relatively attractive proposition compared to our peers and just generally compared to most asset classes. So this here, just a very simple slide, talks about our company. We're about 2,100 apartments, just under. I joined the company 4 years ago. We were 500. Right? So we've been very aggressive in growing, kind of doubled once and then doubled again under my tenure. Organic growth, we've been, I'll show you some history. Last quarter, again, it's been positive our whole period, our whole tenor of since we've effectively been operating, it's been positive, and the average has been close to double digits. I mentioned our buildings the majority of them have been built in the last 10 years. We do some repositioning of assets that we picked up in portfolios. We list here our share price and what the value of our real estate is, the liquidation value, and you can see that once you subtract the debt, the remaining equity is we're trading at about a 60% discount to where that would be liquidated today. We pay a small dividend. It's about 2.5%, 2 to 2.5% yield. And one thing that's in the bottom here, but obviously not the least important thing, is that the people in this company, myself, the board members, collectively, we own over 50% of the shares. So that allows us to act like owners. So I mentioned a lot of things here, but I'll show you a little bit of history and you can kind of, absorb it. It's effectively a very simple story. So here is a snapshot, a visual depiction of our growth since inception. You can see our NOI in the bottom left, and we say as of our last quarter, it was $16 million, but in place today, without some assets that under construction, but in place today, we're about 22 million of NOI. Here is a snapshot of where our properties are located. You can see we're primarily in Eastern Canada, so Atlantic Canada and around the National Capital Region. So about 50% New Brunswick, 30% Quebec, and 20% Ontario. You can see we did a simple, on this chart, it's a very simple analysis, but you take a simple arithmetic average of the cities that we operate in, and you compare that to Canada. Canada's what we kind of glossed over is Canada's highest population growth developed country in the world, and we are in higher population growth cities in Canada. So you're going to see a lot of charts in my deck today, but this is the one where there's no numbers. And really the reason I put this slide together is kind of the secret that no one talks about is that customer retention is much more profitable than customer churn. If you have an old portfolio, what you might have is a lot of trapped assets where tenants have been there for decades and their rents are too low, and due to some regulation, you might not be able to raise the rents to the level of where it should be. We don't have that. Our buildings are newer. There still is a big gap, and they're very affordable product. And you can see these pictures that represents that. The other thing that we do is we actually have a big overlay of services in our building. So you can see some of it here. There's like a massage room, a barber room, a nurse's room. We have electric cars and a car share platform. There's storage. We have smart package rooms. And the reason we do that is they're engineered to save time for tenants and create communities, right? We use software to manage that. And it really, all this is we do all these things to retain our customers or retain our tenants. And it shows up in our numbers in better retention numbers and lower CapEx numbers. So here, this slide really is, I mentioned that we own over half the shares outstanding, and this is kind of the proof in the pudding. We are owners and we think like owners, and here you can see that we act like owners in these charts. So you can see on the top right is organic growth relative to just the public peers, and you'll see our growth is about 100 basis points higher over the last 3 years, and our forecasted growth this year is to beat the peers as well. You look at the bottom right, and that's cash flow per share. So cash flow per share, very good metric. The average is, I'm not sure we'll be doing a lot of 80% year-over-year growth again, but our business is tooled and the way we're structured to do 20 to 30% for, kind of the forecastable period. And, I think that represents one of the best kind of risk reward of any asset class, and especially relative to our peers that are mid to high single digits. I should say that every picture in this slide deck is of one of our properties, so you can kind of get a flavor of what our buildings look like. Here's the team. On the left, you'll see the operating team. It's a tight team. Primarily located in Toronto, but we do have some people closer to where our properties are. And overall, our corporate overhead is around 25 people managing the company. But without talking about myself, I'd say that we're hungry, the team that are operating. But on the board side, we have I would say there's another 6 people, including myself, 7. Collectively, this board has founded and grown and sold 4 to 5 companies worth $4 to $5 billion. So I can briefly touch on some of these things, but you might know, if you're in Toronto, you would know Farm Boy. Jeff York, started that business with a couple of other individuals. He was the CEO throughout its tenure, grew it from 30 million to $1 billion in revenue. Sobeys bought it for $800 million a few years ago. He's now onto his next business. Rick Turner, effectively up until a few years ago, had the largest takeout of a REIT in Canada. If you would have invested day one with Rick until the day his pure industrial REIT got bought out by Blackstone, it was a 20% IRR. And if I go down the list, I'm missing out a lot of things here, like Francis Pomerleau, company with a small regional construction company. It's now a top 3 construction company in Canada nationally. And then JP Poulin has founded a number of businesses with incredible exits. So to kind of go down the list, there's a lot of success, and the mindset of this board is to create value and be aggressive and growing aggressively. And that's what we're doing. Here, that's a snapshot of what organically we're doing. It's effectively, here you can see the path we took by putting up these high growth numbers. These are on a per share basis. Ultimately, we are all shareholders. So our per share metrics matter a lot to us. And there's a green line, if you can see it on this slide, that shows our dividend payouts. You can see our strategy is a little different. We're not paying, the highest dividend paying multifamily name is about a double dividend from what we're paying. We think retaining that cash flow and growing at 20, 30, 40% year over year is a much better value proposition for investors. And that's what we're focused and set up to do. Here, again, I promised no more pictures, a lot more charts. So this is what we're doing here. I would focus on the top right. I mentioned our buildings are new and we attract the downsizer demographic, and it shows up in our numbers. And here, I think, is the most obvious way to look at it. Our CapEx per unit, and this is 2024, we just did it on an annual basis. We'll do it again in 2025 and it'll look the same. But even if you take any year, it's about the same. We're about 60% less CapEx intensity versus all the other peers. And that's for 2 reasons. Our buildings are newer. So just like you have a newer house, you need less repairs. But the other thing that is that our tenants are primarily Canadians who are previous homeowners. So, they know how to take care of their units. They have pride of ownership and pride of living in the buildings that they live in. And that really translates into really strong numbers. You can see on the bottom right that we utilize higher debt, but because we have less CapEx and less dividends, the overall burden on EBITDA is the most conservative across all the public peers. And then you kind of put it all together and you look at your cash flow minus CapEx relative to your market cap. And this stands out like a sore thumb. To us, this is the one metric that if I were to show you one chart, this is what I would show you. You look at the free cash flow generation relative to our market cap, it's almost double digits. Now, part of that, I would say, is a little bit unfair because we do trade at a discount, and I think, but even if we were trading at the same multiple as peers, you would see us at about a double free cash flow yield relative to them. Here, I talk a lot about our corporate metrics, but here's kind of two on-the-ground examples of transactions we entered and exited. And it's rare. We like to own our buildings. These are 50-year assets. But and if you pulled up our share price, you wouldn't really know how well the actual on-the-ground business is doing. But the operating environment is very, very healthy. And today we're operating in a bit of a capital recession because interest rates are more volatile and there's a lot of volatility in the public markets. But when you look at on the ground from a tenant perspective and a landlord perspective, here are two examples. So, two buildings, both bought in 2020. Both you can see the equity check combined $4.7 million. In this scenario, this is actually only $2.5 million of cash, and the other $2 million, 2.2 was shares to the vendor. But we treat our shares like cash, so call it $4.7 million equity check for these two buildings. And you go down the path of ownership, you see that we refied our equity out 24 months later. So we were zero equity in these properties about 24 months after owning them. And then 24 months after that, so 4 years of ownership, we sold the properties, and that initial $4.7 million equity check was almost $13 million. And that represented roughly a 35 to 40% IRR for the company. The reason we sold these buildings is not because these would have been kind of bottom quartile buildings for us, which is why we sold them. And so, I guess you just wanted to exhibit, just illustrate here, how the economics work and what we've been doing with these transactions. So this slide really just shows, ultimately these are 50-year assets, as I mentioned before, long duration assets, and it behooves you to look at these at a larger period of time, not just quarter over quarter. So we looked at a 3-year period here, and then our target is about 2 to 3 years from the end of 2024. So you can see we've had incredible growth. Worth noting that our target column, we have everything in place today. We have the capital and the assets in place today to do what we're saying in our target. And I would say it's a really low risk path to do that, right? So you can see we went from 1.6 million to 14 million of NOI. We're on track to do 30. Our margins have been ticking upwards. Margin to me is free growth. So it's sweat equity that delivers incredible value. So 5 points of margin, if we achieve half of that, it represents about a $20 million uplift. We're 55 million market cap today, right? So you can see that just doing nothing and just operating our business more effectively, there's a lot of upside. On a cash flow per share basis, we went from 2 cents to almost 10 times that over a 3-year period, and we're on track to double it from here, more than double it. You can see free cash flow. This, to me, this year has been an inflection point for our free cash flow. If you would ask me 12 months ago what our free cash flow would have been, I would have said $1 to $2 million. We did 3 in 2024. But this year we're on track to do 6 to 8 million of free cash flow, and next year 8 to 10, right? So I think that's been kind of one of the most important things that's going on from our financial profile. 700 units. When I joined, we were 500. We're at 2,000 in 2024. We're already about 10% or 5% higher than that, and we expect to end the year 10% higher than that. So 3% top line. You get some operating leverage in the business, drives about a 5 to 6% NOI growth unlevered. We're 3 to 1 levered, so that 5% becomes 15 to 20. And then you do a 10% asset growth using your free cash flow, and that 15 to 20 becomes 25 to 30% growth from an investor standpoint. So that's effectively our model. Our shares are trading at around $1.76. I think they might be $1.90 today or something like that, but just around that level. Our NAV today, actually, this is end of 2024. It's a little higher today at a 4.25. And our target is to continue to operate this business in the medium term and drive an 8 to 10% $10 NAV. So I'll leave it there. That's it. It's a simple story. This is a compounding asset. Every time our aim is that every time you pick up a financial statement or look at our company, that the numbers you're seeing will be better than what you saw last time.
Stavro, thanks a lot for that. Reminder, everybody that's listening, of course, if you got questions, please use the chat function and we'll ask the question. Okay, so you've done a number of these acquisitions so far. Stavro, give us a sense of what does the pipeline look like and how do you find your opportunities?
Actually, Paul, 4 years ago, it was hard. It was hard to go out there and compete to acquire these buildings, and it required a lot of personal touch. Today, we're upside down. We've had 3 years of higher interest rates. And anybody that's been white knuckling onto kind of their assets, you see like developments have been pushed aside. So we're seeing a much more active and a much better acquisition environment to deploy our free cash flow. And we're lucky. We're lucky because, a few years ago, we had to raise capital to do acquisitions, right? So there was some dilution alongside. Today, we don't have to do anything. Today, we're just going to use our free cash flow. It's non-dilutive growth, and the deals have gotten a lot better, right? So the pipeline is very robust. I mentioned we announced a deal in April this year, about 5% uptick. We have another deal that we're working on right now that we expect to close. 10% asset growth year over year inside of cash flow is not anomalous for us.
And I guess generally, do you focus on specific cities or do you wait for the deals to come to you and then look and see if that city is something you're interested in?
Yeah, it's a good question. Today, it changes because I do think ultimately the black swan in multifamily in Canada is having too much concentration to one politician, one political decision. So I think about that. But today we have really strong operations in New Brunswick and a really strong operating team in the National Capital Region. And so acquisitions just screen a lot better in those two regions. So we're able to drive value a lot faster, a lot quicker, a lot more with a lot less risk. So if you see us move outside of that, it's usually some sort of partnership, right? Like we did in our Winnipeg deal this year. That's a partnership with a really strong operator, and that's the easiest way to move into different jurisdictions. Ultimately, we're looking to create a portfolio that is resilient but also has growth.
Now, you're buying back stock and looking for acquisitions at the same time. How do you balance where to allocate your capital?
Our number one priority is acquisitions. So we naturally, because these are mortgages, we naturally amortize our debt about 2% a year, right? Roughly, right? So our leverage just goes down 2% a year. And then if you can grow the asset value 2 to 3 to 4, we've been doing 6 to 7, but let's say 3 to be conservative, looking into the future. We don't really need that, but we have been doing that. Then you get 5% delevering every year, right? So that naturally happens. We have a dividend in place, right? That we're not looking to touch, either increase or decrease. I think that's in place. We have some dividend investors, and that was kind of before my time. But I actually think that retaining the capital and growing is the best use of capital. But at the same time, we're a microcap company, low liquidity. Occasionally, we see some sort of selling in the market, and the company has a balance sheet and free cash flow generation to be out there and provide stability in the share price. So we have in the past. So if you look at the last quarter, we bought about 250,000 shares. We used to have a market maker, which is one of these taxes for microcaps in Canada, right? That we decided to just shut down, and instead we just use our buyback as a way of stabilizing the share price when we think that there's some flow out there. So for example, a month ago or a month and a half ago, around when we met. Maybe it was like the day we met. I can't remember. It was around that time. There was somebody called us, and there was a small block for share. We hadn't used our buyback in a while. We bought it, and then we found it as a larger block, and so we were able to we bought 30,000 shares, but also went alongside with an investor that bought the other 170, right? And so we were able to be part of a block transaction that provided confidence to the investor and to the market, and it actually transacted at a little bit of a higher price in the market at the time, right? So for us, it's a tool, not a strategy. Our strategy is to continue to scale the portfolio, continue to increase the cash flow wedge. Our opportunity set to deploy capital is very strong. And so as you kind of go down the line of um, acquisitions, we got our dividend, we're paying down debt, then somewhere around our fourth or fifth priority, we will also use some of that cash to buy back shares.
And you also mentioned that in the structure of some of these deals, you issue shares. What's the ideal transaction look like in terms of combination cash, debt, shares, all the above?
Yeah. So I used to be able to say every transaction, but there was one transaction that there wasn't a share consideration. There was always some form of share consideration as part of the transaction. And really what we're doing is we're solving for the vendor, we're solving for the people we're acquiring from. We get a better after-tax proceeds for them, right? By giving them some shares. And if you think about in the areas we operate, these are local entrepreneurs primarily. We have partners, good construction partners that we can construct, but I don't think the construction risk reward today is that great. And I can go in deep into that if you want to talk about that. But we're able to compete with larger pools of capital, which if we do come across, or just do it in a way that's accretive, more accretive. It's accretive to us on a per share metric, but also creates a better after-tax return for the vendor. And then we were able to do, it just sweetens the deal a little bit, whereby it's a way to transact. The other thing is a little bit of a soft thing is that these developers in their communities, oftentimes we see they might have their parents or their uncles in the buildings. They want to retain some ownership, right? They drive their trucks around. They'll tell us when there's maintenance items. We'll get emails from them. So there is a personal touch there. And I think I don't think a single person, I haven't confirmed this, but I have conversation with them, has actually sold a share. It sits with their accountant. For them, it's a way to retain ownership in the company, right? And so that's the nature of that. But ultimately, corporately, we're focused on per share metrics, right? And so whenever we're doing that, we're making sure that it engineers a better outcome for us.
Stavro, what's the biggest challenge the business faced? What sort of keeps you up at night?
There's the business of running the real estate. There's the business of scaling the real estate, and then there's the business of running a microcap stock.
Right.
So there's three things.
I know the answer.
When you say the business, I have to define.
Yeah.
As you know, I use the term with our board members. We talk about a capital market recession. I think that's true for except for maybe 7 to 10 stocks in the world, right? So that is a challenge, right? I think that ultimately, we told you we've issued shares with the vendors, and in every scenario, we've had to say, hey, look, we're going to buy you for, let's say, I'm going to use an example, like a 5 cap. We're going to issue you shares at a 5 cap. But then they look at the price, they're like, hey, Stav, I'm taking shares at $4, you're trading at $1.80. Right. And then you have to have these long conversations to explain. So that's an issue, right? The other thing is that a couple of years ago, we had a big people issue that has been resolved as construction has stopped. We have access to a lot of really good and capable labor. But and the other thing is in Canada, we have CMHC. 96% of our mortgages are CMHC insured. So access to capital is actually quite good. It's our lowest form of capital, right? So for us, really, it's about how do we get efficiency? How do we drive margins in our business? The opportunities for acquisitions are plentiful right now. So we have capital to pursue them. To be honest, these days, and it's not the answer I would have given you 12 months ago, but to be honest, these days, I think about a share price. I think about, I think about our other shareholders, the 45% that I don't speak to on a weekly basis. That do they understand what we're doing? Do we have are we doing them justice? Is there something we can do to catalyze the share value higher? I think about that.
Yeah. You mentioned mortgages a couple of times here, but what's the typical mortgage duration strategy? Do you guys how do you manage around length of mortgages?
Here's my philosophy. We have assets so when we are refinancing or acquiring an asset, those are typically the moments where you're making a decision on a mortgage. We look at our overall, actually, this slide that I have up, if you can see it, you can see the mortgage maturity, right? That last bar seems like it's a lot, but it's a lot of years combined in one. And you'd see every year we have about 10 to 15% of our debt coming due. And I think that's prudent. The one thing I can guarantee, I'm not good at telling the future, but I can guarantee you, Paul, you and I will be speaking at some point in the next 3, 4, or 5 years, and there will be a financial calamity somewhere in the world, a major one. And you don't want a big portion of your book coming due that year and
Right.
trying to get mortgages. So we want to be able to manage it.
Mhm.
But when you take that aside from a portfolio construction perspective, we look at the individual asset and we look at, is this an asset that we think we have a lot of levers to pull to drive growth? Or is this an asset that's more stabilized? We've done a lot of the growth, or it's, the rents are closer to market. If that's the case, we look at that and that informs how we take a mortgage. So a more stabilized building, we will give ourselves more duration on the mortgage for the refinancing period. The reason and something that we know we have a lot of levers to grow, we'll take a shorter duration. And the reason is refinancing events almost always are positive events for us. So you enter a building, has $1 million of NOI, you have a 5-year mortgage. If you grow it at 3% a year, we've been growing at 6 to 8 corporately. But if you grow it at 3% a year, that means at the year 5, it's 15% higher NOI. Right? If you've done it properly, you doubled your equity. Right.
Yeah.
And so for us, that's how we think about it. So we de-risk on an asset level, we de-risk from a portfolio standpoint. And I, early in my career, Paul, worked in restructuring when I was in M&A. And I saw CEOs handing over the keys and they just wouldn't believe it. Like a year ago, they were out there. And I've seen what that does to people. I've seen that environment, in the credit crisis. And, we want to make sure the structure of our debt is very prudent and very well thought out.
Sort of one last question before we go to the audience here, but is there any sort of amenities or services that you find are returns, sort of outsized returns that you bring to these operations, or do you typically buy things sort of ready to go?
We add a lot of these amenities in common room areas. So we even we'll take a unit offline and do it. Here's why. It makes the leasing, specifically because we're newer buildings, our product will be a little bit on the premium end. Like we're not the landing mat, kind of like budget. We do have some of those properties. So we want the leasing experience to be smooth. People walk through, they have pride of ownership. They see the electric car in the basement. They see the cameras. They see the cinema room. They see the barber, the nurse's room, the massage parlor. Like all these things makes the leasing experience stand out. If you see 4 or 5 apartments that day, you remember our building. We get software. We walk you through the software. There's an app that you can buy and sell in your building, right? There's a community. There's community announcements. People can use the app to enter their building, enter their unit, right? Book some of these common room areas, right? So you get confidence that you can use like the rooftop barbecue, like that sort of thing. So we think that, again, the leasing experience is great. So it starts there, but then we get better customer retention, right? So all these things translate to better economics, right? The switching costs are high, right? And so we like that when we're passing rent increases, that sort of thing. We don't engineer these amenities to drive a huge amount of revenue. They do carry the CapEx required when there is a cost to the tenant in some cases, but we engineer them to get better metrics across our whole portfolio. It's a lot. Like, let's say you start charging $25 to book. We charge cleaning fees and that sort of thing. But let's say there is a cost there. But if we start charging high for these items, I think you move from being a community, right, to a corporation. In the eyes of the tenant, which is what we don't want to cross over. We want people to feel at home and want to live in our buildings. And you'll see, like, I don't know if it comes out in these pictures, but typically when people visit our properties, they fall in love because they're beside parks, nature trails, golf courses, hospitals. They're really nice places to live. And we're trying to add that also inside the envelope of the building so people can, just retain these good tenants that we've invested in. Turnover causes CapEx. Right? Like you might want to, if you have a unit that you can rent for $2,000 and the person is paying $1,200, would that be a positive event? For sure, right? But we for us, the overall turnover is lower in our building. We still get the same, and we showed you before, better growth than everyone else, right? And the turnover is low, and we want to keep that turnover low because we'd rather retain the capital, not keep painting the units, fixing the cabinets when the new tenant moves in, right? And using that capital to, use it as growth capital, not maintenance capital.
Sure. Yeah. Oh, perfect. Well said. Okay, well, listen, let's take some questions from the audience. I'm going to start with Gilles here, who says, looking at Q1 2025 results, total equity is 148 million, number of shares 32.7, equity per share 4.28, share price is 1.79. He says, seems to me business is undervalued, undiscovered residential real estate play. I guess, I mean, this is something you've been saying. You're one of the smaller players, but certainly you are trading at a deep discount to your peers. What do you think you can do differently to change that, or is it just a function of your size right now?
Thank you for listing those stats. We're actually 32.6 now because we bought back about 100,000 shares since that Q1 release. So I think 32.61. I just wanted to say we bought back shares. So you look, last year we were not really generating cash.
Mhm.
People looked at us and they said, "Hey, look, man, like you're going to have to raise capital." And so that could be a negative event for me as a shareholder.
Mhm.
So I don't really want to be a shareholder. We lost a lot of our long-term shareholders, and that's true. And I think that we haven't seen inflows. The other thing that happened in the last few years is that we are owned by some real estate specific funds, and those funds have seen redemptions.
Mhm.
Even if they're like, like I won't name names, but there are funds that we talk to, like even intra, like they'll move from the real estate fund to the money market fund in the from in the investor umbrella, right? So we haven't seen inflows there to see our share price go higher. So that's one thing. I do think we made a very large acquisition late last year, so it hasn't even been. It's about 7 months ago that we closed that, and we haven't had a chance to really. We've reported one quarter
Mhm.
since that acquisition with the full asset package. So I
Yeah.
think as we report this free cash flow, I think people then we show the inflection point in terms of free cash and the ability to scale. So I do think that is an interesting time to look at our company, right? But the other thing that you'll see us do, Paul, is historically we were very reticent to sell properties because we're trying to scale up and it takes a lot of
Sure.
our bandwidth and time to do it, and we like the positioning of our properties. But it's almost it's funny to say this out loud because we're such a small company, but there are actually assets in our portfolio that are too small for us at this point. They would be better taken care of from smaller landlords. And
Right.
so we're looking at that. We've actually ranked them, and there's going to be, you'll see like us release um, even more cash out of our portfolio. And there's a scenario where we can sell 25 units and then use that capital to go acquire 100 units,
Mhm.
right? And a
Sure.
larger portfolio. So I think effectively executing our strategy, showing the inflection point in the free cash flow. To me, that has to be that has to be the go forward path.
Mhm. Yeah. Yeah. Gotcha. Okay. Curtis asks, why a corporate structure, not a REIT structure?
Look, I can answer that a few ways, but if you actually look at the best performing REITs over long periods of time, they're corporations, they're not REITs. Sorry, I said REITs, real estate, publicly listed real estate companies.
Mhm.
And the reason is simple. If you have a good place to put your capital, you're reinvest. Like ultimately, a share price performance. I'm a student of the market as you are, Paul, equals the return on your reinvestment on the internally generated cash flow you reinvest. Like that.
Mhm.
That's how that should work. If you're reinvesting at 8%, your
Mhm.
share price should go up by 8% year over year. Um, so, I think retaining that cash flow is just a better value proposition from a shareholder perspective. So you look at
Mhm.
the best performing real estate securities in Canada and in the US, they are corps with very, very low dividends. So that's one thing. The second thing is I started my career in M&A investment banking. I remember putting together these like doing the transaction in the REIT. And there was this concept of a yield co that was very popular. And I
Mhm.
would see these real estate companies put their highest yielding assets. The other way to say highest yielding asset is your lower quality assets
Mhm.
into the public vehicles, and they keep the best ones with the growth in
Right.
them. And I just kind of thought, as a young guy in finance, I thought that there were scams. I'm like, I see what's going on here. So I didn't invest in public REITs for a long, long time. And like, Next was an investment of mine that I ended up joining the company 4 years ago.
Yeah.
But so I actually think you should be entering assets and growing the yield, right? And
Mhm.
you shouldn't, you're going in our case, our going in yield is healthy, but we have had situations where our going in, like we've seen a negative yield for 2 years, and then we drive a lot of
Mhm.
growth, and we do that purposely, right? So
Yeah.
I don't think you should be beholden to that. And ultimately, a higher dividend rate structure, it's financial leverage. Like,
Mhm.
whether I promise to pay the bondholders interest or I promise to pay the shareholders a dividend, you break a promise. Yeah, there's
Right.
different mechanics, but it's a promise to pay and it burdens your cash flow. And to
Mhm.
me, I'd rather, have the flexibility so that we talked about the financial calamity. It's going to happen in the cycle at some
Mhm.
point, right? We saw a huge, when that
Sure.
happens, you have cash flow to invest and earn those returns for your shareholders, right? So
Mhm. Yeah. Perfect. Okay, second question from Curtis. He says, do you do development or just acquire new buildings?
we have the capability of development. So we have Francis Pomerleau is on our board. Pomerleau Construction is, again, top 3 construction firm in Canada. We have the capabilities in-house to do this. Devcor, we did a transaction with them. They have $500 million of multifamily investment in the ground right now. I am averse to it. I have an aversion to high risk.
Mhm.
I like low risk, medium to high return. I don't like high risk, high return. So, we're not looking to lose capital. However, you will see us do transactions with groups that, because I actually think that's where the value is today. The developers are the ones feeling the pain. It's not the
Mhm.
guys that have portfolios that are cash flowing. And because of that, you're able to structure much better transactions with them. So you will see us take on some development risk with partners
Mhm.
in I would say the near to medium term future. I just know because we're having conversations with them, and the better deals are with those guys.
Mhm. Now, interesting. You basically answered the next question, but I'll ask it anyways. Jill says, what role does DevCor's Jean-Pierre Poulin play in the company? Can you talk about Francis Parmelot's role in the company?
So, we did effectively a merger last year. We were about 1,200 units, and we
Mhm.
joined with a group called DevCore, based and for us it was 3 things. One, it was immediately financially accretive on a share price basis. So our cash flow per share went up by 20 to 30% as a result of that deal. Second thing is, corporately, we inflected into free cash flow positive, right? And thirdly, it diversified us. We were 90% New Brunswick prior to this deal. So
Mhm.
now we're 50-50, right? And so I think those 2 things I mentioned, having too much exposure to one region,
Mhm.
we were actually quite lucky because the first year of ownership, Quebec allowable rents were 6%, and the year before it was like 1.5%. So we didn't underwrite that, and then New Brunswick went from kind of no rent control to 3% rent control. So it was actually a good transaction from a lot of ways for us. Just shows you diversification is good. JP is one of the board members I talk to every week. He is
Mhm.
a great mind. He's developed this company in the last 20 years. If he was public, he'd be the best performing real estate company out there, right? So, I think what it's done for us, and then Francis as well, him and his brother built that company from a small regional player to one of the leading construction companies in Canada. So having that business acumen and their
Mhm.
contacts on the board is incredible for us. They're not involved in the day-to-day. Like, we're
Mhm.
involved in the day-to-day. But, one of the things we got from DevCore that I didn't talk about is that we inherited a team, an operating team.
Mhm.
And, our now head of operations is a former DevCore guy. There was a lot of talent on that team, right?
Mhm.
So that was a very good outcome from this transaction. So I would say, look, it's for us, our opportunity set became much wider by
Mhm.
doing that partnership. And I think that you'll see us announce certain things and put it out. You'll see that as a result of that transaction.
Mhm. Fantastic. Okay, next question. Justin says, I see there's a numbered company that owns 48% of the shares. Who owns the numbered company? What else does that company own?
Yeah, those are 2 board members that are investors in that company. It's 898, and the 2 people are JP Poulin that we mentioned before, and Jeff York that they're both on our board. So
Fantastic.
I mentioned, like, combined with those 2 people, we own about 55% of the shares, right? So the management and the other directors.
Mhm. Lots of vested interest there. Okay, Curtis says, how can you grow aggressively when you have a share buyback and dividend?
Yeah, it's small. We talked a little bit about this. I think that our dividend is quite a bit lower. Actually, I can show it visually.
Mhm.
Uh, our dividend here. This is a good slide. The dark bars are interest payments. So you see, we utilize higher amount of CMHC insured mortgages, which is the cheapest cost of capital in Canada. It's
Mhm.
effectively at the cost of the government of Canada. The middle slice is actually the dividend. You can see it's quite a bit smaller than the other peers.
Mhm.
And
Mhm.
then the top bar, the lighter bar here, is the capex burden, right? Oops.
Mhm.
And so the one thing that we didn't talk here is the buyback is quite small.
Yeah.
But if you do $10 million of free cash a year, you might
Mhm.
have $1 million. It's $1.5 million the dividend,
Yeah.
right? And then from there you might pay down $5 million of debt, and then the remaining kind of $4 million or whatever, you might use that for acquisitions, and there's
Mhm.
a little bit of buyback, right? So that's roughly how that works.
Yeah. Yeah. Gotcha. Okay,
It's part of
Gilles.
the portfolio. Another way to say it is it's part of the portfolio of tools,
Yeah.
but our primary focus is to grow. And I think, everybody says they want to grow, but I think it's pretty incredible what we've done in the last 4 years. Like, we've doubled and then doubled again, and we continue to grow. I mean, already this year, we're on track to do 10% portfolio and
Mhm.
15% NOI. And so that'll translate to about 35% cash flow per share growth year over year,
Mhm. That's
right?
impressive. Yeah, impressive. Okay, Jill says, what got you excited about the purchase of the Winnipeg building?
Oh, yeah. Look, it's a small transaction. It's 1 to
Mhm.
2%. The rents are quite a bit lower, right? So they're $900 rents on average. There's 8
Mhm.
buildings in Winnipeg, older properties, but they're mid-cap properties. There's two things. One is, we realize that affordability is a big problem in Canada.
Mhm.
And so we see the type of people that can rent our buildings. And while we operate at very high occupancy, right? We know there's certain people being priced out of that. So we do like the lower price segment of the market across Canada.
Mhm.
Second thing is, um, we were able to do this transaction. It was about a $2 million equity check to do it. And we expect we'll get that $2 million equity check back because of the structure. And I can talk about that inside of 12 months. So,
Oh.
I can give some details, but basically it's a partnership. It's 170 units. We bought 50% of the asset. The group is a group that we know really well. They're a Halifax-based multifamily company. We're now in Toronto,
Mhm.
but originally a Halifax-based multifamily company. We've been close on transactions before and close to partnering before. In this scenario, um, they had a financial partner sell out of a number of their assets, and didn't have the equity to keep them all inside their
Mhm.
company, right? And so it kind of became a forced seller. And this asset we bought for $17 million, and it had a bid on it for 21 12 months ago,
Mhm.
right? And so we were able to buy it at their original acquisition price.
Right.
And then we also structured that all the cash flow from the asset, whether it's generation or cash flow generation or refi cash flow, comes to
Mhm.
next before we get our equity check. So we have like priority security on cash flows as part of that structure. So it was a very good structure, and it helped. We were also at the time really focused on that lower price point of rents from a portfolio
Mhm.
standpoint, and so we liked the deal.
Yeah.
If you ask me what we're going to do with it, I don't know in 3 years if we're going to have 1,000 units in Winnipeg because we really like the market,
Yeah.
or we might just end up this being a financial opportunistic trade. It's going to fall somewhere between that. I don't know what
Yeah.
what that's going to be at that time.
Yeah. Interesting. Okay, Jill says, any of the properties Next Living owns have excess land that could be built on.
Yes. So we have had that conversation. There's two things. So we actually there's three assets that we'd have identified that are good development assets for us.
Mhm.
I still don't like the risk of funding the development internally versus some of the other deals we're doing right now. Right. So but we do have that. There are three assets where we could build roughly a total of about 300 units on it, right?
Mhm.
The other thing that happens to Paul and Jill, if I got your name right, is that when you're constructing on your property, you cause that
Mhm.
specific building the people want a discount to stay or they want to leave, right?
Mhm.
So you actually cause some disruption in your ops,
Right.
right? And so when you look at it all in, it hasn't really hit our threshold in terms of what to do. But never say never.
Mhm.
We are moving those projects along to make sure. So one of the assets, we have a 4-acre parcel of land in St. John. It's now fully titled for 85 units, right? And so we could sell it to a developer and let them take the risk, and then we can have a
Mhm.
ROFR on the back end. We can do it ourselves, right? There are a lot of options, right? We're just kind of evaluating those.
Excellent. Okay, last question from the audience here is again from Jills. He says, did you increase the rent to the Quebec properties by the maximum allowed by the rental board? Are most of the leases renewable in July?
So we historically had and it's still the case. The majority of our rents reset in Q1, right? At some point, right? And we do the max allowable. On average, we'll see around 5% in our Quebec portfolio, because it depends on actually what it's 5.9 if the landlord pays the heating and pays the utilities, and in some cases we don't, in which cases allowable is lower. It's a little bit of granularity here on how this works. But roughly speaking, our Quebec properties will increase around 5%, and we are telling people a portfolio wise will be 3 to 4, right? So I think we'll either meet that or outperform it. I don't think we'll go below that. Um, and and so the other part of your question is do most of them kind of reset in the middle of the
I guess,
year?
yeah. When do they reset? Yeah.
It's a portfolal. It's at the time of signing the person. So now it's about 50% in Q1 at some point, and the rest of the portfolio is and actually a large part of our portfolio, I don't know what it is anymore. Actually, it's around 15%. It should be around 15%. Is actually in September.
Okay.
So those are the two big months that reset for that.
That are busy. Gotcha. So now I'm going to flip it around to you a little bit. And so we're investors watching the business. What do you think are the most important metrics or maybe catalysts that we should be paying attention to sort of understand how you
Yeah.
guys are doing?
Paul, look, if we're running our business properly, there won't be a
Mm.
catalyst. Like if you're running our business properly, every time you look at it, the numbers will be higher. We will compound. We will be generating more cash, and we'll be doing acquisitions, and you'll blink and we will be 20, 30, 40% higher. That's what our strategy is. And so, but having said that, when you're trading at a 60% discount to the value of these are hard assets that have a very precise value. Like if you look at the multifamily space in Canada, you got stocks, you have bonds, and then multifamily is the third most liquid asset class, right? So there's a very robust market for these properties. So everything, almost anything you do, you could put the strategy on a dartboard and throw it, it will be accretive, right? At this point, and so one of the things that we're evaluating is actually capital recycling. So you sell some assets that you might sell closer to a 4 cap, right? And then you're trading at a 6 cap. So like a 60% discount or 70% discount to that. So there are certain things you can do that can drive a lot more financial accretion.
Yeah.
But ultimately, we're not going to sell our biggest and best assets, because I think that goes contrary to what we're trying to do. We want to experience the growth by owning them. But I do think that those potential smaller sales of assets can, at least give you a marker of value. Like if you're paying attention, you'll say, hey, oh my God, they sold this asset at a 25 or 28 times multiple, and they're trading at an 8 times multiple, right? You know what I mean? And you can kind of see that the assets, you can Google them on Google Maps and you'll see, oh my God, they all look the same, or they're like very similar assets. So there's nothing special about what they sold at a 28 times multiple. So maybe the rest of the portfolio is worth a 28 times multiple. So those are certain things that might happen that might turn people's attention.
Yeah, it's a good way to unlock value or sort of visible value for investors for sure. I've run out of questions. Look like the audience has run out of questions. So Stavro, I'll give you an opportunity just to sort of summarize or give a key takeaway. What do you think everybody should really understand going away?
Yeah, I think for us, we're a simple business. It's an asset class everyone understands. I think participating with our company, you get a very good metrics, very good growth that don't exist in the public markets. And I think that you can kind of almost not have to pay attention because we're shareholders. Like we're very big shareholders in this company. A lot of my personal net worth, if I take my house out of it, it's my largest, position. I think about it all day. But that's true for all the board members. There isn't something else that they're looking. This is a large part of the net worth, and we're all focused on driving the value higher. And yeah, the share price is a little annoying when it's low, but we know what we're doing internally, and we know how the business is running. So you can, you know, we don't have any agency issues, and I think that's those three items are very unique.
Well, fantastic. Well, Stavro, thank you. I think this gives everybody a good understanding of what the business is all about. We've been speaking with Stavro Stathonikos, NexLiving Communities, symbol NXLV on the Venture Exchange. Stavro, would be great to catch up, and certainly we'll keep an eye out for further acquisitions.
Yeah, this is great. Thanks for all the really good questions. Thank you. It was great. It was great to be here.
Appreciate it. Thank you, and bye for now.